Let's talk about the millionaire lazy trader and how you can make at least 13% a year or more with little to basically no risk. And again, this is not for small accounts. This is basically for exclusive for bigger accounts, probably at least over 200-300K or even more, maybe even over $1 million, because the return is pretty small, but at the same time it's pretty stress-free and it's all pretty mechanical. So let's go over and see how it works. So this is a low risk and low maintenance approach, and again, it works best for large accounts. So the overview is, first of all, we need to buy monthly T-bills with 90% of account cash. And then obviously as the account is growing, we will be buying more and more T-bills every single month. And we'll go over an example for every single one of these in a second. Then selling ES puts, crude oil puts, and GC puts, which is gold. Now these are all going to be leaps, or at least or around a year expiration, and we'll get to it in a second. So what is the expectancy? So you can probably make about 3.9% in a year with the T-bills, probably a bit more if the account is making more money, then you'll end up making a bit more. The ES puts can probably make you about 3.5%, as the other ones as well, crude oil and gold. So in this way, the way I'm going to show you in this video, you can probably make about 14.4% return on capital on your entire account per year, with little to no maintenance work, basically, for the most part. Now, obviously, if interest rates go down, you'll be making less on the T-bills, but it is what it is, and this video is it's overall how you can have a pretty laid-back approach. So what is the mechanics for the puts? It's around 365 days to expiration, only 2 or 3 puts per every 100K. So we can have 2 or 3 ES puts, then additional 2 or 3 crude oil puts, and then an additional 2 or 3 gold puts per every 100K in the account. And we're looking to collect about 2% in credit per position. So it will be about $2,000 if we have a 100K account, which is the benchmark account I'm going to be using for this video. And then for the protection, we can either roll the puts if the price is crashing, or buy cheap short-term puts to protect against further decline in price. So for example, if if the market is crashing, you can just buy maybe cheap ES 7 days to expiration puts, or like really cheap ones. So if the price keeps on crashing, you can at least make money on these puts. But overall, because we keep the position size pretty small at only 2 or 3 puts per 100K, you'll see that there's a lot you can do because the position size is really, really small. And I know some people will go ahead and do maybe double this amount and make way more money, but it will be too much risk to take, and this is something I personally wouldn't do. So quickly, let's take a look how I buy T-bills on Interactive Brokers. It's really simple. So I go to the watch list. I type in US-T, then government bonds. Then over here, I'm gonna go to bills, and then I'm gonna be looking for the closest expiration for the end of the either current month or next month. So currently, we are at the end of 2025 August. So 2025-08. So I'm gonna look for 2025-09. which is September 30th. You can press OK. It's going to add it to the watch list. You can just press it here. You can see the yield here. And then if we have a 100K account, I'm just going to buy $90,000 worth of T-bills. So it's always going to be 90% of the account, just because the account P&L can fluctuate. We can have an unrealized loss, and we need to have some cash to be able to deal with it, right? That's really, really important. And if we don't have it, then obviously it's a bit problematic. Then the broker will basically loan you the difference, and then you'll have to pay interest on it, and it all happens automatically, so you won't even know it that you're paying interest. This is how I do the T-bill situation. Now let's take a look at ES puts. How can we buy them? So let's see. Let's find an expiration closest to 35 or 365 days. So we have 307 days, 385 days. Let's see which one. Let's go through to 387 days to expiration. So this is the September expiration in 2026. So let's go ahead and look at the graph here and write in ES and look for the September 2026, which is like this one. And yeah, it's gonna look a bit weird, but all we are looking for here is to see where can we collect potentially about $1,000 per put, and then gonna label it on the graph. So let's see which put gives us approximately $1,000. It's gonna be a pretty far put. So I think here times 50, we're looking for, let's see here. What about this put over here? It's gonna give us 5,000. Yeah, we need way less. So we need about $20, which will be right over here. So 3,100 will give us approximately $1,000 in credit. So this is a pretty far away strike. As you can see, 3,100. So let's just put it in here, 3,100. You can see how far away the price is currently from 3,100. And if we take a look at that, we're looking at about a drop of 50%. So this is pretty extreme, obviously. Can happen, obviously. And this is why we're only gonna take 2 contracts for every 100K. And full disclosure, this is a demo account. This is not a real account. So this is just gonna to illustrate what we can do. So you collect about $2,000, and something I forgot to mention for the mechanics, you definitely would want to take profits at 50% of credit, because those 50%, you can probably get them in less than 100 days, like probably 80 days in this situation, right? So you can do the trade over and over again. That's the thing. That's the major thing, right? So you probably have to do it 3-4 times a year. Now, again, depending on the year. And this way you can get to this over 13% return per year, 13. So this is what I would do for ES, for example, right? So it's crazy how far away the price is, right? It's pretty good. It's pretty safe. And again, some people can go for more contracts. I can see that happening. You'll just have to be more alert if price drops really hard. You'll have to manage it, because the volatility will expand. So let's just see what's going to happen. For example, if price drops 20%, so currently it's at 6696. So let's see if the price drops. Let's see. Yeah, even if it drops, well, this is way more than 20%, but yeah, this is a pretty safe position. You're only going to be down about probably $6,000. So if you take $6,000, so not that much really. Your account can easily take it, and if it's going to lose some value by then, so it's probably going to be even less than that. Now, next thing is the crude oil one. So crude oil, let's go ahead. Doesn't matter what cycle we choose here. Yeah, we can navigate away. So crude oil. Let's look at the cycle closest to 365 days. We have 323, which is July, August. And we have this one. So yeah, we have 355 days. This is the cycle I would go to. And I wouldn't worry about the open interest here. The bid and ask spread is pretty tight. It means the market maker is basically supplying us with liquidity to open a position. So that's not an issue at all. So again, we're looking at the September expiration for 2026 for crude oil. So let's go crude oil. We have September 2026, which is right here. And again, it looks a bit weird. Not much liquidity for the future contract, even though you can probably easily go in and out. Yeah, that's 3 penny wide. So let's see what we can get for a credit of $1,000 per put. And see here, so probably around here, about put number 40 can give us about $1,000 in credit. Margin's very low, so again we can take 2 of these. It's not too bad. Let's see what a put strike of 40 looks like on the graph here. So it'll be approximately right here, and oil should drop. Let's see here, about 35%. So this is a pretty big deal. This is a lot. Obviously, anything can happen, and this is why we are keeping position size pretty small, but really unlikely to happen. At the same time, oil and gold, they crash upwards. They don't crash downwards. So if something major happens, some kind of conflict, some kind of new conflict, the price of oil is likely to go up sharply and not down. the ES is crashing downwards, while crude oil and commodities, they crash upwards. It's the same thing with gold, which we will go over in a second. If something crazy, terribly crazy happens in the world, these prices will shoot up, where the ES might shoot down, right? So it's a pretty good counter. So you'll have positions that are making money if things go really bad, and you'll have a position, the only position on ES that is potentially can lose money. Still have an unrealized loss, I guess. So this is a pretty good thing about commodities. They crash upwards, so you can sell puts and be quite happy with it. The same way you can probably sell some calls on ES. It'll be the equivalent, I guess. So this is what I would do, and even if the price drops from 62, let's say, to 50, yeah, you're gonna be down by about 3,300 on the position. And again, if the price drops, usually volatility goes down. For the most part, it depends on what happens, but usually commodities crash upwards. Now let's take a look at gold, and we will do the exact same thing with gold. And let's see what range we have, what credits, and everything in between. So 364 days. This is the October expiration. Let's see if we have any liquidity here. If we don't, let's see, it's gonna look. Yeah, we don't have. If you don't have any of the bid and ask prices, then we don't have any liquidity. There we go. So we have some good bid and ask spreads here on this cycle. So this is the August expiration for gold. So let's look at the August expiration for gold right here. So this is August 2026. Okay, and let's see where can we get about $1,000 in credit. So no, this is still quite a lot. Let's see here. We can go pretty far away with gold. Gold, we need to go to $10 on the price. So $10 will probably be around here. So the bid and ask spread is a bit high here. So actually, let's just go to 2,700. Just a nice round number. So we can go 2 contracts. Even though the spread is a bit higher here, it's still gonna be a pretty okay fill price. And let's look at the strike 2,700, what it looks like over here. 2,700. So you can see again, pretty far away for gold. And like we said, anything can happen, but the gold has to drop a good 23, almost 24% for us to be really in trouble. And even if it drops to, let's say, 3,000, let's see what's going to happen if it drops to about 3,000. Yeah, we're going to be down about 12K, which is quite a bit. So in this case with gold, I would either take a higher strike to get more credit, or I would lower my contracts to 1. But either way, the most important thing here is not to over leverage. And this is probably the most important thing, because over leveraging or opening too big of a position, it's where basically people kind of destroy themselves on one bad trade. But this is how I would trade for myself if I'm gonna be totally fine with making 10 to 15% a year. As of right now, I'm okay with doing more work and making more money, but at some point in time, in my trading career, I'm definitely gonna be more laid back, and I would just wanna make those 10-15% a year laid back, have really low risk, and be able to protect my positions by rolling or by buying cheap puts if I need to. So this is it for this video. Hopefully it was really useful, and yeah, that's all I got for you guys. Thank you so much, and I will catch you in the next one.